everybody. Welcome to your hump day. It's Wednesday. TraderMerlin show. Good to have everybody with us. Good to see all my regulars, and we got a few new names I can see out there. Hello, everybody. Good to have you with us today. If you are new, do me a favor, hit that subscribe button. That way you'll be notified when we do the show every day. That little bell also helps on your YouTube channel. And, of course, at the end of all this, if you can make it through the very end, if you're a glutton for punishment, and you feel like, you know what, I actually like it, you can give me a thumbs up. But do that at the end. Let's make sure you like the content here today. Now, I'm pretty sure that you will, because we've talked about the different financial products. Yesterday we talked a lot about Forex, we've been talking about crypto, we've been talking about futures, options. We talk about bonds probably once every month, maybe month and a half. And the reason for that is I'm not a bond expert, and personally I look at bonds and I go, not enough yield out there for me. However, most investment advisors are going to tell you that bonds are an essential part of your portfolio, so we'll make as much sense of that as we can today. We're going to talk about what are iBonds in particular. That means we'll also talk about tips and other bond products. But my guest today joining us from the East Coast, we've got Mr. Bill Addiss joining us. Bill, glad to have you back. How you been?
Hey, Merlin, always a pleasure to be here. Thank you. Good to be back. Great. Welcome to talk to everybody.
Yeah, it's good. I haven't had a chance to get you on the program in quite some time. So how you? Anything new going on in your world? What's up? Uh-oh, I lost your audio. Your audio disappeared on me. You were totally fine, and now all of a sudden the audio just disappeared.
How's that? We back?
Yep, there you're back. Okay.
All right, hit the wrong button. Sorry. No, it's just been a pleasantly busy time. Year end, clients have looking for more training, so I'm living a Zoom life, and that's very nice.
Is it really nice? A Zoom life just seems so unless you're part of the 900 people who got fired the other day on a Zoom call. That's you know.
Really. Really. No, I can't wait to get back in the classroom. Zoom has been a great stopgap, but I can't wait to get back in the classroom.
Yeah, I agree. I think it is a total stopgap. I miss it. Actually, I'm in talks right now to hopefully start doing some physical classes back in Irvine, and I can't wait. I love the energy and the excitement of being in a physical classroom. Now, before some people might be joining us who don't know your background, you do lots of teaching or for financial firms and for the Fed. Are you still teaching for the Fed right now? Is that class over?
Yes, still have that contract with the Fed, so I'm over at the Fed twice a year for training for them, and I'll be doing their summer program and then another year end. So yeah, the Fed's a client of mine.
Awesome, good. Well, they've got a lot on their plate right now. Maybe you can help steer them in the right direction. So
I don't know about that, but it's nice to be able to say I'm over there and to see what's going on.
Absolutely. Do you get to like a special pin, because I taught at university and like the professors got this special pin, like you're part of the club, the Illuminati.
No, but it is, as you might imagine, pretty high security because that same building is where most of the world keeps their gold. I train at the New York Fed specifically. And that's where, we've got 58,000 tons of gold sitting in that same building. Most of the world keeps their gold there. So it's pretty high security. You don't want to go through the wrong door. You wind up getting security on you pretty quick.
Yeah, it's funny. When I was in college getting my finance degree, I ran a financial management organization, and one of the trips we organized was to go to the Federal Reserve in San Francisco. And It was nice. They actually took us down into the bowels of the Fed, and you could see through one gigantic big portico door with bars on it. You could see the gold room, Yeah. And then another room that was like the Indiana Jones warehouse, but just nothing but pallets of money. And you're all going, man, I'm scrounging around for $20 to get lunch today, and there's a pallet of $5 million right there. Good times.
That's a great building right there on Market Street. That San Francisco Fed's a beautiful building, and their vault is 1/10 of what, well, actually even less of what the New York vault is.
Wow. Well, if you ever get the chance, everybody go out there and just see if you can get a tour of one of the central bank Federal Reserve centers. It's pretty awesome. Very cool kind of experience to do. All right, let's talk about bonds today. We've talked about the steepening of the yield curve in the past. We talked about the potential for rising rate environment, which I think is probably more on the table now than ever. And we've talked in the past about specific products, like if you were to buy a normal bond, a rising rate environment is not really good for you because you could get more income stream by buying a current higher yielding bond. But there are bonds that allow us to capitalize automatically on a rising yield environment. So how about we start with a real quick overview of tips, and then we can jump into the iBonds.
Sure. And if I may, I'm even going to take a step even a little bit further back just to begin with, because, my whole life is basically educating on bonds, interest rate, the Fed. That's what I've done for 40 years. But I don't want people to misconstrue my education with an endorsement or, I'm out there being a cheerleader. Right now, I don't see a lot of reason for the average investor to buy bonds right now. It just doesn't. I mean, a 2% 30-year treasury, you tie up your money for 2% for 30 years at a time when inflation is already eating away your money at 6%.
Right.
That makes absolutely no sense to me. So, and I do have to, and we'll talk about it later, but, we've now got the situation where even Fed members are talking about maybe the Fed has not been proactive enough about fighting inflation. The Fed just threw in the towel last week, and Powell finally admitted we're not using the term transitory. And we're talking about inflation. It's a real problem. The Fed finally admitted it. We've been talking about transitory for 9 months.
I love watching that too. He finally is like, yeah. I believe it's maybe time for us to retire the word transitory. It's like, no shit. Really? You just figured this one out? It's like the guy who gets swept up by the avalanche.
By the Fed.
Right.
That was really them throwing in the towel on the whole idea that this inflation is going to be temporary.
Right.
So if already you've got a negative rate of return of 4% and inflation is going to continue to go higher, you're only going to get hurt even worse. Mm-hmm. So I'm not a real advocate of bonds, but the fact that inflation is going so high, and we'll know Friday, again, how high it's going, we can actually turn that into an opportunity by buying floating rate bonds that are tied to inflation.
And I think the discussion there, Bill, would be like if you are, I guess, under the impression or the need to hold bonds. Again, I love how you said it, and I think this is important for every asset class, is even though you're an expert in bonds, you know them inside and out, there may be in a time and place where you go, no, maybe bonds aren't the thing for me. However, many people are looking for that income stream, and if that's the route you're going to get, that kind of consistent payment stream, then fine. But again, there's a spectrum of products in that bond world, and Margaret asks here a great question. Says, well, what if you already own a bond fund? Well,
great question.
We're probably going to get to that right now.
Well, exactly. I couldn't pay Margaret to ask a better question, because the other way you might think about tips is as portfolio insurance, right? You already have a bond or a bond fund. As interest rates go higher, as inflation goes higher, you're going to get hurt. That's just a reality.
Right.
So might you maybe think like the institutional investors do and have some tips in your portfolio to act as portfolio insurance on your income side, on your safe money side, if you will. So that way, if inflation does go up, what you're going to lose in terms of market value of your ETF would be offset by your increase in income on the TIPS bond. In the institutional world, they use TIPS as an insurance policy.
Right. And again, the TIPS are tied to?
Well, and this is the bond now, so let's get into the specifics. Thank you. So that was all intro. So the TIPS bond is a bond that started to be issued by the U.S. government about 13 years ago, and it is a floating rate bond. Now, the vast majority of bonds here in the U.S. have a fixed coupon to it, right? The fixed rate of return. We even call the bond market the fixed income market. But these bonds are slightly different. They float, they adjust, and they float to the inflation rate, CPI. So specifically, if CPI increases, goes higher, that's actually going to increase your rate of return on this investment, on these TIPS. Now, I got to get into the weeds just a little bit, and you know this product well enough, Merlin, so help me out if I get stuck in the weeds too much. But what floats on these bonds, to explain, when the government issues these bonds, they put a coupon to it, like every other bond, and it's a fixed coupon. What floats on these bonds is a little bit more different. What floats is the par value of the bond. Bonds come in $1,000 denominations. Well, these bonds do too. But the way these bonds work is every 6 months, we look back and we say, okay, what happened to inflation over the last 6 months? And let's say it was going at 6% annual. That would be 3% for the 6-month period. Well, at the end of 6 months, we would increase the par value of the bond by 3%. So now the par value of the bond is $1,030. 3% higher. So you're going to earn more interest income, not because the coupon is changing, but literally the par value of the bond is increasing. And then as importantly, when the bond matures, so let's say inflation averages 6% a year for the next 10 years. Let's be really negative. Okay. All right, a 6% inflation rate for 10 years.
Let's hope not.
At the end, go ahead, I'm sorry.
I said let's hope not.
Yeah, let's hope not, exactly. But what that would mean is, in the case of this specific bond, at the end of 10 years, your $1,000 investment of the par value of the bond has now appreciated to $1,600, right? 6% a year for 10 years is 60%. So now the par value, your maturity value of your bond, is $1,600, not your original $1,000. That's a nice benefit.
Right.
As well as every time the par value of the bond went up, your interest income was going up because the par value was going up. So in a rising inflationary environment, I really do like the tips. And there's no thing I can say good about fixed bonds right now.
The challenge with the tips, though, and it on surface, we listen to it and you go, well, shoot, man, I know rates are going to go up. I mean, if 9 times out of 10, if you told me right now where it's going to go, it's going up, right? It's just the economy is dictating that. However, it may sound attractive, but there's a premium you're paying to buy tips, right? And they know that there's this demand for them, so the price gets driven up. And I don't know if it's still negative right now, the yield on the tips. I was actually going to try to bring that up.
Because inflation has now reared so high. See, that's the problem. You have kind of a lag effect there. The coupons reset quarterly.
Right.
So you get a lag effect there. So I agree with your observation. Nothing is free in life. Let me take a step back. Your fundamental premise, I 100% agree with. Nothing is free in life. These bonds offer some nice upside in an inflationary environment. What do you give up in return? Coupon. A regular treasury, as low as they are, will yield you more income than a tip will. Mm-hmm. Because of that upside opportunity you have. And the more we anticipate inflation, the more that upside is worth, right? Mm-hmm. It's like anything else. So I don't disagree. That's also a reason, quite frankly, why I like the TIPS ETFs. Because TIPS bonds themselves, when and if you want to go sell them in the secondary market, they can be very cumbersome. The liquidity of TIPS is not great because the bond market's over the counter to begin with, and not a lot of people know TIPS. So for that reasons, I actually like TIPS ETFs for that liquidity reason. You got much better liquidity.
Mm-hmm. I like that the ETFs, and we talked about that on the show in the past, that there are several different ones out there. Again, I know, Margaret, you were asking about TIPS ETF. When you are looking at those, remember, there's usually very low liquidity. These are not as popular as something like TLT or SHY or JNK. So the liquidity is certainly not there, but they are an option. And Margaret says, does a TIP ETF count as much as TIP? I think it's still the same thing because, Margaret, my understanding, a TIP ETF is simply going to hold a portfolio of TIPs. So it's still going to have the same basic math structure. Right. The difference is your TIPS ETF is going to charge you an administration fee and certain fees. So I don't know, maybe 1 or 1 point something percent.
Actually, did you have the slide that I sent you on the TIP ETF?
If you sent me a slide, I've got it. So let's see. Where do we go?
It was one of the 3 that I sent. Because for Margaret's, I'd like to highlight a couple of points here if I could.
I got it. Yep. Okay,
so the TIP ETF is an ETF. Now, it happens to be the largest. It's BlackRock's. It's the largest. They've got $28 billion. And this is constructed of a portfolio of 10-year maturity TIPS.
Okay.
If you look, though, the expense ratio for this is pretty low. It's only 19 basis points.
That's pretty cheap.
Expense ratio. So, fee-wise, this isn't too bad relative to the asset class. But again, look at these rates of return. Now, this is a portfolio of treasuries that are floating rate. But look at the year-to-date return. We're almost at 5%. The 10-year treasury is only yielding 1.5%. The 30-year is only yielding 2%. And if you look on this slide, I've compared this basket of 10-year maturity TIPS to the 10-year maturity treasury ETF. Many of you are familiar with IEF. Uh-huh. That's a 10-year treasury ETF, which, by the way, only has $13 billion in size. A lot of people know TLT and IEF. TIP is actually almost twice as big as IEF in terms of size.
Yeah.
But if you look, the IEF, because interest rates have gone higher this year, right? That means prices are going down. So the IEF, you've had a negative 3.5% rate of return year to date on that. That's why I don't like bonds. That's why I don't like them.
Yeah.
So look at this. You've got a 10-year IEF treasury portfolio with a negative 3.5% rate of return for this year to date. You've got this TIPS bond, positive 5%. It's even a directional difference. Mm-hmm. I mean, here's why we've been marketing. I mean, you've been helping us. We've been talking about TIPS now for a year as inflation is going up. Mm-hmm. This is a perfect illustration. For 12 months, IEF is down 4.5%. TIPS is up almost 7% for 12 months. So here's a perfect illustration why you maybe don't want fixed rate bonds, but you certainly might want something like a TIP.
Yeah, guys, there's a few of them out there. TIP is one. Let me just real quick bring up a couple different charts for you.
Thank you.
Bear with me as I bring up the my trading screen. So the main one that he mentioned is TIP. right? That's
Right.
the big daddy out there. That's the biggest volume one anyway here in the U.S. Again, for your different countries outside the U.S., you may want to look at your local markets and see if they might have some inflationary products, because let's be honest, inflation's everywhere at this point. It's not like
Right.
it's just the U.S. phenomenon. SCHP is another one. This is the Schwab. Again, they're just building a little portfolio. Those are the two major ones that are in the tip space. So.
Right. Right. And I thank you for pointing out globally, because the U.S. was the first government to introduce this type of product, the inflation floating rate bond. Other countries have replicated. The U.K. has a big program on the TIPS product. So, yeah, other sovereignties can look into it as well.
Oh, all right. I was going to, let's see, where was I? I was looking at your PowerPoints here because you sent in 3 slides, all of which I think are great. Your initial one where you talk about iBonds, right? So we talked about tips. Maybe we can dive into iBonds a little bit.
Yeah. So the theme for today's session is floating rate bonds. And tips certainly should be at the top of that list. And we've talked about that. But there's another type of floating rate. I'm going to call it a bond, but it's not. And I owe the OTA community an apology, actually.
Oh, wow.
I'm here to plead mea culpa. Because as you and I were talking about tips, and I've been talking about tips in the Signature Series class I do, I would frequently get a question about this product called iBonds. Mm-hmm. And I would honestly dismiss the question because it wasn't on my radar screen, because these things that we're going to talk about are not bonds. And I'll explain what I mean by that. These are things that are called saving certificates. Now, I don't know how old your audience is, but some of you might remember as kids, you might have gotten for birthdays or graduations these Series E and Series H saving certificates. They came in $25 and $50 denominations. Grandmas were famous for giving them out at birthdays.
I've got a $100 one still sitting in a box.
Bingo. I got a $25 one sitting somewhere. And these are actually vestiges of the old war bond program. That's what this harkens back to. And these aren't bonds. They're saving certificates because they're non-negotiable. The way these are basically zero coupon bonds. You buy them at less than 100. When it matures, you get your 100, or whoever you gave it to gets the $100. The difference is the interest you earned. Right. But by the way, and I'm sure you know it, once that certificate matured, you're no longer earning any interest. So it's a nice novelty value, but you're not earning any interest on that investment any longer.
I'm actually losing value. It's funny because I dug it out, and I think it was I think that thing matured in 1985, So literally for the last 35 years, that thing has just been sitting there, and it's losing value because of inflation. So
absolutely, and inflation is eating it away. It's going to be less than what your grandmother paid to give it to you.
Right? She would be rolling over in her grave right now. Sorry, Mary Suze.
Exactly. It's a good novelty. Frame it. It'll be a good lesson. So these bonds are not liquid. You can't sell them. And by the way, on the Series E and Series H bonds, which are the most common, probably what you have, even today, the interest rate on these things is abysmally low. Mm-hmm. So honestly, I've never even had them on my radar screen. My background was as a Wall Street trader. This isn't a bond. I didn't care. And unfortunately, I brought that attitude over to OTA. So when I was getting questions about iBonds, I just totally dismissed it. And that was an error, because the truth is these bonds are extremely attractive. Extremely attractive. I mean, I'm going to tease your audience for just a moment. These iBonds that I'm going to explain in a moment will yield you 7% government guaranteed. Actually, more than 7% government guaranteed between now and April of next year. That's one heck of a rate. Yeah. I mean, it's more than 3 times any rate you can get on any other government product. Right. So 7% is well worth attention. So I think we should spend a few minutes, because if inflation goes up, that number also is only going to go up. Mm-hmm. This is an inflation-linked bond, but it's structured very different than the TIPS. But what I didn't stress is these iBonds stand for inflation bonds. Mm-hmm. These are bonds that peg their return to the inflation rate. And, you've been discussing on numerous classes how inflation has reared its ugly head. Well, now we've got a bond, a certificate, a savings certificate, which lets the investor take advantage of that. That's a heck of an opportunity.
Sure, and I've got your screen up here, and it's interesting to note, you talk about the 7.12 annualized rate, and then I think what's interesting for me anyway is down at the bottom, says note the prior period yield was 4.8%, so you see an increase of 2.3% just over the previous issue, and that is just a sign that inflation is running at such an elevated rate, right?
Exactly. And that 4.8%, by the way, was also reflecting at the start of inflation after we opened things up. So even that 4.8% was rather high relative to interest rates at the time. Now we jump up to 7.1, too. It's even more attractive. You're absolutely right.
Now, are these the same? Is this something I'd go to like Treasury Direct to get? Like, how does one get these?
Yeah, so let me explain a little bit more on that as to how this works, and then we can talk about how to buy them. So these are savings certificates, and they're only issued with a 30-year maturity.
Oh, okay.
So you're going to buy them with a 30-year maturity, and you can buy them in different multiples. We'll talk about that in just a moment. But the way these work is the Treasury Department, every 6 months, every November and every April, resets the coupon on these bonds based on the inflation rate. And actually, there's two components to it, just to get in the weeds a little bit. The Treasury Department sets a fixed rate component, then they add the inflation on top of that. Now, the Treasury Department has, as of late, not had a fixed rate component to it. It's just been the inflation part. And actually, it's kind of weird. I looked into this. The Secretary of the Treasury is appointed to determine the fixed rate component. And they're under no obligation to say how they do it. They could literally do anything they want for the fixed rate. As of late, for the last year, they've kept it at 0 because the inflation component is so high. And for some reason, they make a big deal. If the Treasury Secretary is not willing to make that decision, they have to appoint a designee. Apparently, making this declaration is a big deal to somebody. So it's either the Treasury Secretary or their appointee. So every 6 months, we set a new coupon to this bond based on this fixed component, which is now at 0, but more importantly, adding the inflation using the CPI rate. So it's a direct, whatever changes are to the CPI for that 6 months, that will be reflected in the floating leg component. So that's where we're getting the 7.12 from, is because inflation has so highly reared its ugly head.
Right.
So that is the coupon now until the next reset date in April. They only reset it twice a year. So those people who come in and buy these certificates now will get that 7.12% coupon until the coupon resets in April. Then you'll earn whatever the new rate is for the next 6 months, and then so on and so forth. So if inflation does rise, this 7.12 is going to go even higher. But of course, it's a double-edged sword. You got to be fair. If inflation doesn't rear its ugly head, the coupon on this bond could go down.
Right.
But the beauty is it will never go negative. We have a floor here. So no matter what happens to deflation, I mean, if we really get into a recession and deflation, you'll never get back less than what you paid to buy these certificates. It'll never go negative. So there's a floor. That's nice. So you have upside opportunity, but limited downside risk. So you're buying, though, a 30-year certificate. And this is where the liquidity comes in because, I'm a bond trader. I want liquidity. I know usually the OTA community likes liquidity. These bonds are not liquid. So the way it works is you're investing in a 30-year certificate. If you want, you cannot get your money out after the first year, for the first year. There's a lockout period. So you can't get your money within the first year. If after a year you want to pull your money out of this program, you can. But between years 1 and 5, if you pull money out of this program, you'll earn all of the interest less a 3-month interest penalty. That's still not a bad.
No. I mean, 7.12 is not, nothing worth shaking a stick at. That's pretty good.
Absolutely. And then after 5 years, if you want to redeem it or redeem it, there's no interest penalty. You'd earn all the interest up to that point, and you can just cash it in.
So let me ask you a couple questions because I think Big Ab is going to lose his mind if I don't ask these questions. I got to be careful with Big Ab. Pretty soon he'll expect me to do a 2-hour show if I don't get to his questions. Where's the first one?
It's nice to be loved.
Yeah, it was about limits on these ones. So the first one, I don't know where it is actually, Big Ab. I'm scrolling back here. You guys have been pretty chatty. I love it. It was basically how much of the tips can an individual buy? There it is. Is there a dollar limit on how much an individual can invest in tips, and also for these iBonds?
Good question, Ed. On the tips, it's unlimited. It's like a treasury bond. You can buy as much as you want. So there's literally no limit on the tips bonds. Now, if you buy them through the Treasury Direct program, this is a program we've talked about before. The government sells you bonds directly. You don't have to go through a broker-dealer. And there's a website and a program called treasurydirect.gov where you can buy any treasury through that and pay no commission. Now, on that, they have limits, I think, of 100,000 per trade. So that's just for administrative issues. You can come in and buy subsequent offerings, but I think per auction, they limit it at 100,000. But if you go into the secondary market, you can buy any amount. So on the tips themselves, consider there to be virtually no restrictions.
Okay.
Now, on the iBonds, there are some restrictions. And this gets into your question as to how you can buy them. So if you were interested in buying the iBonds, there's two ways you can do it. You can do it on treasurydirect.gov, and you can buy the bonds right online. And if you buy these, and I keep calling bonds, if you buy these certificates online, the beauty of doing that is you can invest based on any dollar value. You can literally down to the penny. You want to invest $5,692.35, you can buy an iBond of that denomination.
Oh, wow.
So there's a benefit to buying them electronically for that. Now, on that, there is a limit of $10,000 to buy them electronically for the iBonds.
Okay.
Now, the other way to buy them is you can literally send in an application and buy them, or buy them through a bank. And there you're buying the paper certificates like you're holding in the drawer. You can buy paper certificates that come in $50, $100, $200, $500, $1,000 denominations. So you would be getting the certificates just like you have. Now on that too, there is a $10,000 maximum on that. But here's the odd quirk. If you have a tax refund, you can literally use that refund to buy more iBonds. Literally on the electronic filing, and I didn't notice this, you are offered the opportunity on your return to buy iBonds. And if you choose that option, you can supersede the $10,000 maximum.
Yeah, that was actually a question from Alan. He says, what kind of bond do you get when you file taxes and you check the refund as bond box? Is that the one?
Right. That's it.
Funny. I didn't even know.
Yeah.
I don't think I've ever taken...
I had missed that until just recently myself.
Has anybody here ever taken a refund, tax refund as a bond? I have not. Have you?
I have not.
Nah, I want my cash. I want it ASAP.
Really?
I'm already nervous I'm not going to get my refund, so if I don't know if I can trust the bond either.
Hey, if you can't trust the bond, you can't trust the Treasury. So you're in a disadvantage no matter which way you look then.
And Margaret says duration for iBonds, you mentioned it's 30 years.
Yes, for the iBonds, they only have one maturity, and that's the 30-year. But again, after 5, you can cash it out. So what does it really matter?
Right, unless you think you're going to be shorter term, then you're going to pay some penalties there, which could eat away at that yield. But still, as he's got here, 7.13 is pretty darn good for a bond product.
Great. That is great. But
yeah.
I do want to stress, because I've had some questions on this. Remember, if you invest in this for only 4 months, let's say the rate is going to change in April, you invest in December, you're going to earn 4 months of that annualized 7% rate. I just want to make sure everyone's aware of that. You'd earn 1/3 of that rate, basically.
Right, and let's say all of a sudden, the Fed manages to jump in and rates just get absolutely slashed, and all of a sudden, you find yourself at 1%. You're still going to be stuck at 1%.
Right, exactly. But I do want to point out, and I think the genesis that we wanted to have this conversation is, last week with Chairman Powell really was a game changer. The Fed has been in this problem with this stagflation problem. If they admitted they had an inflation problem, they'd have to do something about it. Mm-hmm. And doing something about it would hurt the economy. That's the reality. So they were doing this tightrope dance. And the Fed finally had to admit, with inflation now approaching double digits, the Fed finally threw in the towel last week and said, no, we can't use the word transitory. We have an inflation problem. And I think that bears all the more why a product like this is going to be important on a going forward basis. I'm real curious to see what Friday's CPI number is going to be.
Yeah, it's interesting. I actually have a couple people that I know that are going, it's going to be over 7%. I don't think we'll be over 7. I'm actually thinking the way that's setting up, it almost feels like you're going to actually have a decline in it, and then it'll start to increase again going forward. But it's almost like they've been setting it up for this shock factor of, hey, you know what? It's okay. We're not that bad.
Well, that bad is relative, right?
Right.
Because the general consensus I know is in the market is 0.6 for the month. For the month. Mm-hmm. But remember, that's down. That would be down from 0.9 last month. Last month we had a 0.9% monthly unemployment number. So even 0.7 would actually be down from where we were last month.
Right.
I mean, inflation has just spiked.
Yeah, and I actually have it up here right now. This is the CPI number, guys, and don't forget that this happens Friday, 1 hour before the markets open. So you got another day of people kind of curious. Right now, CPI is probably the most important piece of economic data coming out in our marketplace, and this is why I love trading, because you can go back a couple of years, nobody gave a shit about CPI. Right. Not a big deal. Who cares? It was Fed funds rate. That's still a hot one, but if you take this is first place right now as the Fed policy. They've made it pretty clear. kind of dictated by CPI and how that inflation number looks like. So be ready for this one on Friday. And this is they're expecting it to be 0.7%. That's kind of the industry average. So we'll see how it.
Right. And just while I've got you in the audience here, I'm sure you're all aware. Also, then look out for December 15th, next week, when we get the Fed announcement.
Right. Yeah.
We got the FOMC meeting. How much are they going to be tapering? That's the $64,000 question. If you're admitting inflation is a problem, what is your policy changes going to be?
Bill, you got to get with the times, buddy. There is no $64,000 question anymore. It's like the $64 trillion question. Come on. You remind me of Austin Powers. $1 million. Like a million's nothing. Come on.
All right. So how about I say the 2 Bitcoin question is?
There you go. Yeah, and that'll be real interesting because this will definitely steer that conversation. I'm sure he's got a boilerplate script to be read on the 15th. But there's some holes there that this report will fill in, and then their actions, I think, will definitely be played into what happens to the CPI numbers. Let's see what else I got. Mark says, what's a tax refund? Good one, Mark. I like that one. Lori, you won't be here in 30 years. Remember, you don't have to wait the full 30 years. That becomes an asset at that point. You could sell it to someone else.
Right.
And, if you find ourselves in an environment, well, it's an adjustable one, but I won't go down that route. Let's see. So iBonds are only sold direct and no secondary market. Am I correct?
Correct. And that's it. There's no liquidity. There's just the opportunity to redeem them directly back to the government.
All right. Sure, the government would love that. More damage for them. All right.
Well, actually, if they're paying an 8% interest, they might want to retire it.
Sure. Yeah, corporations do the same thing, right?
Yep, exactly.
Gets too high, let's retire. Tell me a little bit about your program. I know you've got a signature series, Bond Aid. I was actually just watching Live Aid the other day. That's a great show, so maybe I get to watch your show as well as Bond Aid. Tell me a little bit about your program and what's their schedule looking like going forward.
Yeah, what happened was with the pandemic and shutting down the other classes and so on, as you know, the firm came out with the signature series. So I was asked to put together a 3-day signature series on the topics I did with you guys, which is understanding the bond market, interest rates, and the Federal Reserve. Because the bias I bring is I don't care if people never trade a bond, kind of as we're showing in this discussion today, talking about the Fed and interest rates and CPI. I don't care what asset category you're trading in today's market. It's being impacted by the Fed, the economy, and interest rates. So this is not just a class for bond investors, although we do certainly address that. And for the bond investors, my bias is investors, when the time is right, and I don't think we're there, can and should be buying individual bonds themselves. It's just a lack of education that people don't understand. Why pay a manager a fee to do something like construct a ladder or construct a barbell, things that you can do yourself? So we provide those tools as well. But I do spend a lot of time on the economy, the Fed, interest rates, and the interrelationship between, as you and I have done on your show, the interrelationship between, for example, what the Fed is doing to stock prices,
right?
Or when the Fed raises interest rates, how does that affect commodity prices? So that interrelationship between all these markets, I just find fascinating. So
you're a total nerd, and the good news is so am I, because I mentioned this many times. Like, to me, the financial markets are like you open up a really classic old school watch with all those little cogs in there, right? Every one of them works in harmony together to give you the time. And if one of them's out of whack or broken, it doesn't function. So, granted, there will be times where in the markets where something is out of whack, the bond markets or the real estate market or the equity markets. But knowing the actions of each of those, I think, gives you a competitive advantage, so you can kind of see when the dominoes are falling and how they may fall. Right, a rising rate environment, it doesn't mean it's the end of the world. It actually just means opportunity if you can figure out how those pieces work and position yourself accordingly. So iBonds, tips, certainly ways to capitalize on this rising rate environment we have right now. And at some point, how does that impact the equity markets going forward? It's going to be a pinch. The higher the rates go, that means the less likelihood that people will be able to make those financial obligations, meaning those debt payments, and then we can start to see things struggle. Because remember, it's not just the treasuries. That leads to higher corporate debt. And if all of a sudden corporate debt goes from, let's say, 5% to 12%, they may not be able to make those payments on those bonds. And then all of a sudden you get defaults and all kinds of issues. So, it is a domino theory type of market, and I'm excited to be a part of it with the bonds as well. Let me ask you this question. This is from T. Cruz. It was from early on. He says, Bill, it looks like the yield curve is steepening as the longer end of the yield curve moves higher. Is this a result of the Fed tapering their buying program or something else?
No, that's a great question. It's really the result of two things. It is the fact that the Fed is now tapering. right? They bought all these bonds to raise prices and drive down yields back in 2020. They did it. Congratulations. Now they're no longer printing money. They're no longer a big buyer. And in fact, depending on how aggressive they go on the tapering, they could actually start selling some of this huge portfolio. So the mere fact the Fed is now tapering causes upward pressure to interest rates, long-term interest rates. And then the other thing that causes it, which we've been talking about this whole session, is the rising prospect of inflation. You know, the market isn't stupid. If the market sees inflation, that means investors long-term want to be compensated for that inflation. So the greater that inflation rears its ugly head, the steeper the yield curve tends to get. The longer you tie up the money, the greater you want to be compensated for that. So, and that's why I don't think either of those factors are going to diminish short term. That's why I'm continuing to look for long rates to continue to their rise up. You know, we've kind of been hovering here at 1.5% for a couple of months. I think by year end we'll break through that. I think long rates are poised to go higher because of those same dynamics, which are continuing.
Yeah, I mean, it's interesting. I actually have it up here for you. So Cruise, I know you can't see it, Bill, but for Cruise, you know, where we're at right now is this hard red edge. And this actually, it says September 2017. So let me get to 2020. Wow, this is weird. Okay, so there's where we are right now. You can see it's actually, feel like it's starting to flatten a little bit with that 30-year kind of dipping down the way it has over the past few months.
Right.
But notice where we've come from. If I go back into 2021 July, right, that long end is actually kind of dropped a bit. It was up over 2.3%. Now all of a sudden we see it drifting back down. But
year over year it's down, but not in the time frame you're looking at. Exactly,
yeah. So again, this is just an animated yield curve. I love the animated yield curves out there. You guys can check that out. I can actually post it in the chat if you want. Let me just do that for you, because I know some of you guys like that, and it's a goofy little toy that I like to play with it as well.
Yeah, that's a fun toy.
It is.
You know, the obvious impact, though, is, you know, the reason the December 15th meeting is going to be so important is what everyone's going to be wondering is, when is the Fed going to start raising rates?
Right.
At the short end. And that's not going to be good for the equity market when that happens. You know, we've had zero money for the last 2 years.
Yeah.
What's going to happen when the cost of money starts going up? So, you know, I'm not predicting the taper tantrum, but just even when you look at, you know, things like dividend discount models, if interest rates are going up, the prices are going to go down.
Right. Yeah. And it's interesting because I've brought this up a few times, and you talked about stagflation and kind of how they've backed themselves into a corner, because if they try to fix one problem by, let's say, oh, I have inflation, so I'm now going to raise rates on the short end of the yield curve. Well, that's a traditional way to fight inflation, but now all of a sudden I'm putting constrictions on the equity markets, which all of a sudden might start to see businesses suffer, and then layoffs happen. So then, oh, well, how do we stimulate growth to get jobs back? Oh, well, we have to lower rates. Well, wait a minute. We just raised them so we can fight inflation. So now you're like, damned if I do, damned if I don't.
One hurts the other. What they do for one, I mean, they got to be blue with apoplexy. You know, when they try and address one, they're going to be hurting the other. That's the type of that all central banks are dealing with right now, not just the Fed.
Right. You know what I want to see, Bill? I want to see one day where, you know, it's kind of funny, as this Jazine Maxwell thing is going on, right, as she starts to testify, you notice how many CEOs step down? I thought that was kind of an interesting thing. I would love to see, you know, Powell walk in there and right before the day of the announcement that he knows it's like, they're going to grill me. I don't want to make this call. He steps down the day before the announcement. I just want to see that happen, where he's just like, yeah, I'm not going out there. I'm not facing the public.
I'm not getting in front of that audience.
Not getting in front of that one. Margaret asked this question. She says, if we buy foreign bonds, is Germany the best place?
Wow. It depends what you mean by the best.
Right. Subjective.
Germany is the best credit quality. Germany is AAA rated. You know, we've got a number of countries. The Scandinavian countries, Germany, are AAA rated. The U.S. is only AA rated. So, you know, when you say best, if we're talking credit quality, yeah, Germany is the best. The unfortunate reality, though, is, and we've had this conversation, is most interest rates in Germany are still negative.
Yep.
If you invest in a 10-year German Bund, your rate of return is a negative 0.5% right now.
But I'm safe.
Versus in the U.S., yeah. Negative 0.5%. You know, 1.5% positive here in the U.S. suddenly looks a little bit better. So the answer is yes, you can, and there are sovereign bonds for all, even emerging as well as mature countries. The question is, though, too, what interest rate are you getting? But also realize you're taking currency risk then, right? Because if you want to buy a German Bund, it's denominated in euros. So you're going to have to convert your dollars to euros. And so your rate of return will not only be based on your interest, which is negative, but also what happens to your currency there. So be careful.
You know, and I think, Margaret, you know this from even just this show, but like when you have something that's extremely safe and has the highest rating, It's inverse correlation. Those yields are going to be the lowest. If you got something that's, wildly crazy, like you want to buy some Turkish bonds right now, that's nuts. That's so unstable, so risky that they're going to pay you a lot of money for those bonds. Oh, sure, we'll give you, I don't know what Turkey's charging right now. Is it 10, 12, 15%? Who knows? It's crazy over there. I wouldn't touch that with a 10-foot pole, but it sounds nice to go, wait, I can go to Turkey and let's say get 15%, or I can get, -1 at Germany. Well, why the hell would I go to Germany? Well, because it's safe.
Much safer, exactly. And by the way, talking about safety, I'd be remiss if I didn't point out, it'd be interesting to watch the talking heads on TV tonight, because we had a pretty important person in the market. I don't know if you remember the name Bill Dudley. Mm-hmm. Bill was the head of the president of the Fed, Dallas, for many years. Yep. He was the vice chairman of the FOMC, greatly respected. Bill was on CNBC this morning literally saying, I think Fed policy is wrong.
Whoa.
And he actually uttered the dreaded word bubble. He thinks the credit market is in a bubble. These abnormally low interest rates that I'm talking about are the result of abnormally high prices. And you've got the former vice chairman of the FOMC worried that the bond market right now is in a bubble. And, the problem with the bubble is you don't know it's a bubble till it pops.
Right.
Something being overvalued is not a bubble. But I will certainly agree the bond market is overvalued now. These bonds are historically low yielding.
How
I don't
dare
think we got a bubble, but he does feel that way strongly.
How dare he? He's part of that central bankers fraternity going against his brotherhood or sisterhood or just the hood?
He must have taken the antidote from the Kool-Aid, because he's not drinking from the Kool-Aid here.
Yeah, kind of interesting. I think it's a sentiment that's actually been somewhat voiced by other members of the Fed, which has been, look, this is a bubble. I then said the word bubble, but asset prices have gotten ahead of themselves. I've heard that term said a couple times by certain members. Right. But like you said,
he uttered the dreaded B word.
Yeah, and I agree. I think not only is it an asset price in a bubble, but you have an asset bubble, a bond bubble, a housing bubble. Hell, you can even throw in a crypto bubble if you want. But we have such an inflation of asset values. Hey, you know what? Everything's going to keep going up until it doesn't. So it doesn't mean to short the hell out of it right now. All right, Bill. Well, hey, we got. Oh, yeah. When is your class? So you talked about.
Thank you. We were talking about the signature series. Yep. So we're running them on a quarterly basis. So the next one is the first week in March. So the other thing we do is before the classes start, the month before, we do a weekly series called the Showcases.
Yeah.
So starting at the end of January and running the entire month of February, I'll be on the calendar every week doing the signature showcases, where we take a snippet of the information, either the product training or markets training, Fed, and we kind of do it for the whole OTA community. So I'll be back with you guys weekly, starting at the end of January, going into February. And then also I'm committed to a monthly XLT session. So the next one will be January 4th. I'll do an XLT with the group. So we were trying to build in a calendar here. I enjoy working with you guys. You're a lot more fun than my institutional clients.
Yeah, I bet. Well, hopefully we can get a physical class, because I feel like this is almost like a little XLT program you're doing here for us. So I appreciate you coming on and giving some pointers for the way that these iBonds and interest products work. So thank you so much. I hope, if I don't talk to you before then, I hope you have a fantastic remainder of your holiday season, end of the year.
You too. Always a pleasure. We will get together in person next year, I swear.
Well, if you need to get away from that East Coast cold, California's got sunshine right now. Just saying.
It's snowing here in Washington, D.C. So, yes, that's exactly. I got to get out to Irvine.
That's you do. All right, Bill. Hey, thank you so much. Always appreciate it. Take care, my friend.
Be well, folks. Well to everyone. Happy holidays.
Guys, that was Bill Addiss. You can find out more information about his courses from your Online Trading Academy Center. Again, he's doing a 3-day bond class called Bond Aid. He said that's in March. And also in January, he'll start doing some XLT and some showcase pieces, giving us some more insights into kind of what's going on in the bond market. Love having him on. I can see we had a lot of fanfare for him as well. So I try to get him on once a month. Big Eb says, to sum it up, put your money in crypto. No. Put some money in crypto. Diversification's key here. But all right, what else do I got? He's probably a Kool-Aid booster now. Historically, do bond markets fall sharper than stock markets? That's a great question. I don't know if I have an answer for that one. I would say no, because usually you don't get that sort of intense volatility that you do with equity markets. So I think the fall will be slower. Certainly, I think it'll decline. But I don't know the exact relationships there. So, I think that was it time? It's already time for me to wrap up. I didn't even have economic calendar out there, but there are a few announcements coming out for Thursday. You do have natural gas storage, and you guys may have seen today we had crude oil numbers come out. They were expecting a decline of 1.5 million barrels. Actually came out at negative 0.2, so a lot better than expected, and because of that, you would think we've had a bigger move up in oil. Here's what's happened with your oil. It was up a little bit today, 0.43%, not too much. Really muted indexes out there, especially coming on the heels of some crazy up moves. As I mentioned yesterday, we talked about the Dow because somebody said, well, why don't you talk about the Dow? Notice the Dow is right at supply. The NASDAQ is right at supply. The S&P is right at supply. And the Russell, well, the Russell decides to play its own game and is not doing anything even remotely close to coming up to supply. So keep your eye on that. You might see some downside pressure in our markets. I don't know if it's a reversal or just a small little blip, but we are coming into a level where it would appear that these markets are due for a little bit of a correction. And then you had metals today. Really not doing much. There's your gold, and silver looks pretty much the same. And for those that want to know crypto, we did have a little bit of a bounce. There are some that are performing very well. Fortunately for me, I have a position in EOS, which is up 13%. But I guess we can say with the big names out there like Bitcoin. Where's BTC on this list? I should always do it by alphabet. All right, just make it easy on myself. Here's your Bitcoin, kind of chopping all over the place. But you notice what's great about the moves that we've seen in Bitcoin today and actually over the past couple of days, very long bottoming tails. That's a sign of buying pressure, closing near the high for at least 3 out of the last 4 days. So that's pretty good. Positive news for anybody who's holding long Bitcoin, although this downtrend that started back in early November, still intact and looking pretty darn ugly. Is uranium correlated with the oil market? I don't know. Now, unfortunately, I don't look at anything in uranium. I think we looked at it one time on this show, but it's just not something I take a peek at myself. So, other than that, not a lot to really look forward to for tomorrow. That was your major economic announcements with regards to earnings. It isn't really the best earnings season. Today you had GameStop, which I guess we could look at. Tomorrow, let me bring it up here. You have Lululemon. Cronus has been reporting, say they're reporting every week and they haven't, but you've got Broadcom, Costco, Oracle. Those are the 3 big ones for tomorrow. And just before we wrap up, I'll take a peek at GameStop for you guys. Here is GME, just so you can see. Right now, down another 3.8% in the after hours. So I actually expected to fall a lot more than that. I thought it'd be a bit further down than that, but fortunately no. Did I get into Render? Yes, I did buy Render. So I'm in a Render at 425. Yeah, let's see, where's the Render token? Got a Render at 425. Actually, I got it yesterday or 2 days ago. So not so happy that it's drifting back down. The one that I did not get into and I have an order in is on Sand. Hopefully that will execute tomorrow morning. And so when I do my Crypto Investor Live program tomorrow, we will hopefully get me long on the Sandbox. Margaret says, I bought Mara today. Marathon, huh? There's Mara. Been a good couple days for it. From a technical perspective, it looks like that was a good pullback. Now the question is this thing going to rally back up, break that 52 or 53 mark, and continue higher? Well, I think that there's still plenty to do in mining as well. So I think there's plenty of opportunity there. It's obviously a great discount, over 40% off what it was just a couple weeks ago. So great value buy. Just the question is, will it get back up to those levels? And Margaret, you're probably thinking, doesn't need to get to 80. Just get me up to like 60, 55, 60, and you can make a nice profit on that one. All right, that's going to do it for me, everybody. If you liked today's show, if you made it all the way through to the end, which most of you probably did not, but if you did, you can give me a thumbs up if you liked it. If you didn't like it, email me at TraderMerlin@gmail.com and tell me, hey, I didn't like this. You can fix it by doing that or this, or even better, say, hey, I'd like to talk about this specific topic tomorrow. Tell me more about this topic. And if I can, I will. Obviously, for a lot of the in-depth kind of strategy pieces, you're going to have to go to Online Trading Academy or whatever your respective school that you want to go to is. I don't go into those strategies per se on the program. Now, tomorrow, since you guys asked, I am going to have the Ambassador of Opportunity on the program tomorrow. John O'Donnell, who used to be my co-host on Fridays every day for Power Trading Radio for the better part of a decade, he will be my guest tomorrow, and we'll probably talk macroeconomics. I'll do my best not to get political on the show, or at least to steer away from the politics side of things, but we'll see what John's take is on this economy, on inflation, on interest rates. He's slowly becoming a Bitcoin maximalist. It's kind of interesting following old John on social media, but he's like more and more the Bitcoin discussion and digital gold. So that will be our guest for tomorrow. Friday will be a show with just me and a glass of whiskey, but thank you guys so much. Hope you enjoyed. Bill Addiss. If you want to know more, contact your local Online Trading Academy. And find out about his Bond Aid series. He's just a great guy with a wealth of information. So thank you, everybody. Have a fantastic Thursday trading session. I'll see you tomorrow afternoon. Bye.